HMRC are collecting much more tax revenues from your savings interest than they used to. They recently released a tax bulletin that showed in the 21 to 22 tax year, they collected around £1.4 billion of revenue from savings interest. But in the current 24 to 25 tax year, that's expected to be around £10.2 billion. That's an increase of 6 times as a proportion of income tax liabilities. But rather than lining HMRC's pockets, there are things that you can do to protect your savings interest from being taxed. I'm a qualified accountant and experienced tax professional, and in this video I'll explain why your savings interest could be at risk from being taxed and what you can do to protect it from HMRC. According to data from AJ Bell, around 2.1 million people will have to pay tax on their savings interest in 24-25, and that's compared to just 650,000 people 3 years ago in 21-22. There are really 2 factors that have led to the increase in people paying this tax. The first one is rising interest rates. So you can now find savings accounts that will pay you 5% interest on your cash balances. That's really good for making the most of your cash savings and earning some passive income. But it does mean that there's a risk that that savings interest will be taxed. First of all, it could exceed any tax-free allowances that are available for your savings interest, but also that extra interest could also push you into higher tax brackets. And the second factor is that the personal allowance has been frozen at £12,570 until 27-28. That's a bad thing for taxpayers because most people will see an increase in their wages year on year along with inflation. But if the personal allowance is frozen, it means that more of their salary will be in the taxable bands rather than in that tax-free personal allowance. Historically, the personal allowance has increased every year or every couple of years. And so the fact that it has been frozen until 27-28, which is something called fiscal drag, is not good news for taxpayers. And then let's talk about PAYE. So most people are taxed under PAYE because that's how employers collect income tax and national insurance on salaries. That also means that HMRC will automatically calculate how much tax you owe on your savings interest and then deduct it from your payslip. And you might not be aware that you have to pay any tax on your savings interest. But there really is no way to escape that because banks will automatically share details of your savings balances with HMRC. But you don't need to be paying the tax on your savings interest because there are legal things that you can do to avoid paying any tax on your savings interest, which we'll talk about later on in the video. Now let's quickly cover off how savings interest is taxed. Savings interest is taxed in the same way as your salary is taxed, and it's the usual income tax rates of 0%, 20%, 40% and 45% that apply. But there are some allowances that are available for savings interest, which I'll quickly run through now. So first of all, you've got the personal allowance, which as we discussed is £12,570, which you can earn tax-free. That's frozen until 27-28, but it does mean that if you haven't exceeded the £12,570 with your salary or pension income or any other income, then it can go some way towards sheltering your savings interest from tax. The second allowance is the starting rate for savings, which lets you earn £5,000 of savings interest tax-free, but it's only available if you earn less than £17,570 in a tax year. And it's tapered away by £1 for every pound that you earn over the personal allowance, which again is £12,570. And then the final allowance is the personal savings allowance, also known as the PSA. That's £1,000 that you can earn tax-free in savings interest if you're a basic rate taxpayer, but it's reduced to £500 if you're a higher rate taxpayer, and it's zero if you're an additional rate taxpayer. But more and more people are finding themselves being pushed into those higher and additional tax brackets because of fiscal drag that we spoke about earlier, because people are earning more from their salaries whilst the tax bands are frozen. So a lot of people won't have any of their personal allowance left. They won't qualify for the starting rate for savings, and they might only have £500 left of their PSA or nothing at all. So now let's talk about what you can do in order to avoid paying any tax on your savings interest. And I'm going to talk through 3 different strategies that are available for most people. Number 1 is the cash ISA. This is probably the easiest way to avoid paying tax on your savings interest. The cash ISA is a tax wrapper, and you can invest up to £20,000 in a tax year into your cash ISA and not pay any tax on the interest that you earn on that cash. Historically, people haven't bothered with cash ISAs because interest rates have been so low that they haven't always exceeded their personal savings allowance. But now that interest rates are rising, ISAs are becoming more relevant again. Secondly are premium bonds, which are another form of tax-free saving. You can invest up to £50,000 into premium bonds and there's no tax to pay on what you make from them. But you don't earn interest on premium bonds. Instead, you get entered into a monthly prize draw, and the prizes are cash anywhere from £25 to £1 million. The NS&I have said that the average return that you'll make on premium bonds is 4.4%. And they've also said that there are typically 2 people who will win £1 million every month, but you could also end up winning nothing. So it is a bit of a gamble. But remember that you're not gambling the cash that you've put in there. All you're gambling is the interest or the cash prize that you might win in a month. Number 3 is to invest in the stock market. You don't want to keep too much cash sat in your savings account because typically the returns on your cash balances will not beat inflation. What tends to beat inflation is investing in the stock market. So it's typically advised that you keep between 3 to 6 months of living expenses in cash, plus 12 months worth of any short-term projects that you know that you'll need to pay for. After that, you want to consider investing in the stock market. The average returns of the S&P 500 since it was introduced in 1957 has been 10.5%. That's way more than the 5% that banks are currently offering on savings accounts. And you can invest in the stock market through tax wrappers, which makes it tax efficient as well. So you can use a stocks and shares ISA, which means that you won't pay any tax on the returns that you make on your investments. And the annual limit for investing in your stocks and shares ISA is £20,000, but you do have to share that with the cash ISA. So that £20,000 limit is shared between the two. And the second way that you can invest tax efficiently into the stock market is through your pension. Your pension is another form of tax wrapper because the money that you invest into your pension has not been taxed. So rather than paying the tax away to HMRC, you get to invest more of it into your pension instead. But just remember that with a pension, the money is locked away until you're 55, so it might not be suitable for everybody. I hope this video has been helpful in giving you some ideas of how you can be more tax efficient with your savings. Thank you for watching, and I'll see you next week.